Hello and welcome to the NEST Edge. My name's Gloria. I'll be stepping in for Dan today. I also have Sean McDougall, our portfolio manager, on this webinar as well. This is the NEST Edge. Purpose for this is to really provide some guidance and also share our unique way of looking at data. This gives us an edge over the choppiness of the markets and various news cycles. Just to let you know, this is not investment advice. This is solely for educational purposes. We use education to make informed decisions, and we find that it's very important to be educated as you are part of the investing game and also investors yourself. And so for those of you who have listened to our webinars before, we would like to move forward with building your portfolio with us. Please feel free to reach out at info@nestfinancial.net and we'll be happy to talk. If you know of anybody who is interested in learning more about investments, have a portfolio for themselves, and just want to learn more, please share this webinar. It will be posted on our website. Or just send me or Sean an email and we'll send it directly to you.
Don't send me an email. I don't want it.
Okay, so mine is Sean.
Laura, you did so much better than Dan. I'm going to tell him that too. You did a great job there.
Thanks. So this webinar usually has Dan on the call. As I said, I'm stepping in for today. So Sean and I will have this great conversation on inflation, which is the exciting topic for our recently released NEST Edge newsletter. And so this topic is very important for investing. Many people tend to underestimate it and say, that, we're not seeing much of a difference, but these little tiny increases, every year that are hidden in things for everyday use as well, will start to build up. So to start off, let's see, we'll have Sean share a little bit of history about inflation, kind of the past couple of decades, and what's a healthy goal for inflation to be at?
Decades. How to answer that question quickly. Really, for the last, let's call it 2 decades, or at least the last one, it's been held down. I would argue quite heavily artificially, really out for sure since the housing crisis, but even maybe you can go back as far, there's layers of it back in these early, like the tech mania. But really since the housing crisis, our inflation has been held kind of down. Interest rates have been held down artificially to kind of help us get out of that fog. But some of the older listeners on this call, I don't know who's on this call. I just know that there's definitely someone older than me. Can remember mortgage rates that were 3, 4, 5 times what you're seeing today. Inflation is not a new thing to this country. Historically, we've seen it before. It's usually for different reasons. It's for multiple reasons. It's been here for over a year. It's been ripping for a while. It's just back, and it's just kind of freaking people out because we haven't seen it in so long. The Fed has a mandate of trying to have a goal of 2% year over year, inflation. That's their CPI goal. Try to get to 2%. Well, we're kicking the shit out of that. Like no problem. Even if they're like, I'll call it faux numbers because they have manipulated how they count that CPI. We're at perfectly topical today, 5.4 year over year. That's huge. And it's probable that it's going to continue to creep back up into 6 by the end of the year. It's definitely not transitory as the financial media would like you to believe. It's been as obvious as last summer that, commodity prices are starting to really pick up steam, and we're just continuing to see that. Like it's not going away. It's sticky. It's here. How do we deal with it?
Yep. And then also you had mentioned in the newsletter, that inflation is the silent killer. Can you elaborate on that?
Yeah, it's pretty simple. So today, compared to a year ago, that $100 you had in your savings account lost, to keep it simple, 5% of its value. So $100 a year ago is only worth, 95 today. If that keeps continuing, you'll just erode your purchasing power of your money in your savings account, which sucks. Things that are, it doesn't sound like a lot, but for example, let me get to something that some people buy often. Cheese. Cheese is up 8% in the last month. Milk is up 8% in the last month. Oats is up 31% in the last month. So it's stuff that you buy. Coffee is up 16% in the last month. This is not like rare earth materials that you don't really directly see. It's here. It's and you're going to see it. Your grocery bill when you go to the HEB, instead of spending your normal $250, it's going to cost you $280. You're just going to see that little bit of everything's a little bit more expensive. People are used to gas prices kind of fluctuating. That's been more prevalent in the last few years. But everything is going to get a little, especially housing costs are just bonkers, especially locally. It's insane.
Yep. And many of the big metropolitan cities, they're seeing there's a huge impact on housing costs, whether you're renting or, owning a home. Or buying a home. This is a pretty rough time. So good thing is that interest rates, have been low for quite a while, but with inflation picking up some steam, that's going to change, right?
Yeah, it's creeping up. Again, a lot of that is based off of what the Treasury yields are doing, which have tripled in the last year. What the Fed's fund rate, what the Fed, the monetary policy that's currently being used or not used at the time is going to affect that. With all of this inflation numbers coming out, that's even more likely that the Fed is going to start the nasty tapering word is going to start next month. They're going to slow down their bond purchases. And what that's going to do is let the yields creep up even higher, which is going to increase interest rates, which in theory, according to academia, which will counteract inflation. We'll see. I'm not, it's not as simple as that. So we'll see.
And talking about the government and the Fed, there is so much talk about transitory, that inflation is transitory. It'll be here for a while, then you don't have to really worry about it.
It's no big deal. It's no big deal.
But,
it's not a big deal.
This is what the government is saying, right? What big media is spitting out almost daily. And so, Sean, let's all hear your opinion on this transitory.
I mean, I don't have an opinion on this as a fact. It's not transitory. It's not. You struggle with math if you think this is transitory. The head of the Atlanta Fed recently came out. Was that yesterday? It was within the last 24 hours, I'm pretty sure. This week for sure. That said, by definition, this is not transitory anymore. I'm like, no shit, buddy. Like, where have you been? Welcome to the game. And that opens up another can of worms of like, what is if the Fed is honest about what they know is going on, they wouldn't be doing all these, you wouldn't see these guys resigning because they're doing all these day tradings under the table because they see some data and then let's not go down that rabbit hole. Let's stay focused today. Dan's not here to help to keep us on track. So
I gotta reel you in.
Yeah. Exactly. I warned you. I will go down a rabbit hole.
So, Sean, the CPI, Consumer Price Index numbers came out today. How's that looking?
Warmed up. It's we anticipated last month was going to be kind of a cooling off. The rate of change was going to cool, and it did. And we expected this month to pick up, and it did. Year over year, month over month, everything increased in September. We anticipate, and it is probable that rate of change is going to continue into the end of the year. There's, it's more, that's the most likely scenario. So we're positioning for rising growth and rising inflation for the rest of the year. We've been positioning that away for, because we had to take some down commodities because we expected a cooling off. And then the last few weeks has been really, we gone, up each model's commodity exposure by, from relative to where it is now, 30%. Not all models have 30% commodities, but from where it was to where it is now, we've been really aggressive. I mean, we bought it this morning. We bought soybeans, wheat, and some corn this morning. They were down. They were on sale.
They're on sale. Go get your soybean.
Yeah.
So with the economy, you know, in this situation of course, COVID, supply chains still trying to recover. I mean, things are slowly backing up. Of course, there's a Delta, and who knows what other variant of COVID may appear, right?
Who knows? Yep.
You know, there are some labor shortages and companies just having to pay more, right, for workers. So all of this is all adding to this inflation, right? This expected ramp up in inflation. And
thank you for saying all of this, because it is not one.
Yep.
And the media wants this. Oh, it's just bottlenecking, and then once the supply chains reopen, everything's gonna be fine. I'm like, well, depending on the sector, there's more to that story. So it's just you can't just get hooked on a headline, assume you know what's going to go on, and live in this linear world. And once this one thing changes, everything's going to go back to normal. It's like it's never that simple. It's never a right or a left. It's a gray in the middle. Yes, we do have bottlenecking. We do have labor shortages, but it's not as bad as you think. According to the own government's numbers, again, it's the government's numbers. Unemployment's at 4.8%. I mean, like, people are employed. Now, whether they're helping unload the boats at the docks, or, you know, shipping containers, prices have gone, I don't know, depending on sizes and ports, you're talking up at least 4x. It's just more expensive to ship things, so they're shipping less. It's never as just one thing as you think. But yes, there are lots of factors that are pushing this inflation up. But this is going to take time and space to kind of cool this off. We didn't get here overnight. We're not going to get out of it overnight.
Yep, it is going to take some time. So no more transitory, you know, just get that out of your head. Oh, not your head, Sean, but people who are watching.
Honestly, I used to get kind of fired up when I hear these just absolutely bogus, bonkers lines. And I'm like, perfect. Never change. Like, always be 6 months to a year behind me. That is wonderful. It is sad because these, you know, whack jobs or wackadoodles, they're the ones that are, you know, implementing policy and or managing a lot of other people's monies. And it's like, oh, that sucks, you know, but it gives us an edge. But I'm happy that people are just now, our competition is just waking up to inflation as a non-transitory event. So it's great. They're going to run to where we are, and then we will exit stage left when it's like, all right, now you can take all my soybeans back. I'm out. See ya. That's where we are.
So all the models, well, you know, with all of this considering, you know, all the changes in the economy and everything moving towards inflation rising, where are we? You know, what quadrants are we in economically? I know you touched on it, rising inflation, right? Rising growth, but what does that mean for the portfolios that you're managing and for, you know, clients?
Yep. We are sliding. It is probable for Q4 of this year, we're sliding back into quad 2. It's not going to be as intense of a quad 2 that we saw like the beginning of this year, where inflation commodity prices just exploded, and that's when our models were positioned perfectly and we took advantage. It should not be that extreme, but we are positioned for that environment. So we like commodities, we like energy, we like financials.
Can you share,
I'll just,
Sean, a little bit about what positions we're in now? And
Yeah, I mean, at some level, it's some type. Everybody's got exposure to energy, Netherlands, technology, Germany, Switzerland, Russia. Some REITs are in there. Industrials are fading out. Saudi Arabia and financials. The European exposure, they're in a different economic quad than we are. They still have some run up in the COVID cycle. You know how we're having right now in the United States. The Delta numbers or all COVID cases are starting to roll over. Europe's, 3 months ahead of us. So that was really the exposure reasons for that is economically they're a little farther along in the opening up. And And then the Russia and the Saudi Arabia, that's a little more straightforward. That's energy. You can think of those countries as a great proxy to what a barrel of oil is going to do. It's like buying Russia and Saudi Arabia is an indirect way to buy a barrel of oil. Whatever oil does is going to swing those countries in that direction. So it's just a way for us to spread a risk around a little bit. Mm-hmm. And then, commodities is we have a ton of them. I wouldn't say that we are like loaded to the gills with all of them. Like our more aggressive models only are like 25% of the entire model is commodities, but we have cattle, natural gas, which has been a fun one, corn, copper, coffee, cocoa, soybeans, and wheat. Those are things that we have been loading up on the last few weeks, and we'll hold them until they get oversold, and then we'll start fading out of them.
All right.
Or overbought. We don't want to sell oversold things. That's
overbought. Yes.
Overbought. Yeah. Don't sell low. That's dumb.
Yeah. So that's kind of a little overview, of what. I'm talking to all the audience now. Overview on how we're looking at inflation, how it's being managed, and also what our portfolios are doing. How we're set up for that. I wanted to open the floor up to questions. If there are any questions, feel free to enter them in the chat box. Should be towards your right. Let's see. So it looks like we have a question. Thank you. And I'm just going to read it out loud.
Yeah.
Do you see it? Do you see it, Sean? I'll just read it out loud for the audience.
I see it. Yeah.
So if inflation is 6%, where it was 2% before, and before your goal was a 4% return, 2 points over inflation, is your new goal 8% to stay even when you were shooting for 4%? And can you see achieving it? Also,
I know where you're going with this. So each model has a stated goal. I do not take that into account. It will happen naturally inside them. That's part of the reason why we saw such a ramp in Q1 of this year of, why all the models are, at 1x, 1.5x of what their goals are. That will happen naturally. I was a lesson that I've learned a few years ago that you do not adjust the goals. If things are ramping and you're positioned correctly, it's going to offset that. But what he's talking about is real rates of return. So you have, if you got 10%, but inflation's 5, well, then really you only made 5. But the models themselves, the goals stay the same. But if you're doing what you're supposed to do, it will offset it.
Great.
But again, inflation could go to 6 and then fall to 3 in a month. And then again, it's how are you evaluating what is inflation, what is not inflation, what is counted, what is not accounted. If you get into that, then you really can get into the weeds and not be able to turn around. But at all times, I promise, I'm trying to make as much money as I possibly can, risk adjusted. Can you be more specific? What is the return on investment?
So that was another question. Mm-hmm. What is the return on investment for this quarter?
Like the one we're in? It depends. We have 5 different models. Mm-hmm. And it depends on, I could give.
So we have 5 models, and the returns, these are what we call total return portfolios. So 5 models, and each model has a target return ranging from 6%, which is our considered most conservative, and then our most aggressive portfolio that is 20% target. And so, Sean, do you want to maybe share something that's in the middle, like our moderate portfolio that targets
not counting
8%?
So
right?
Yeah, moderate. Not counting today, moderate is up 0.65 this quarter so far. Year to date.
When you say this quarter, Sean, is it the start of this third quarter? I mean, the start of this fourth quarter?
Yeah. I mean, she
so
said
we're
this
13
quarter.
days. We're 13 days into the quarter.
Yeah.
And already up 1.49.
Not counting today, which I think we're up about 30 bips right now. Year to date, moderate is up 10.15, not counting today. And over the last year, it's up 12.4.
So year over year, 12.4.
Year over year. And the goal is 7. So it's still 7 sleeves. Sorry, hopping around things.
So yeah, I hope that gives you some,
Yeah.
that answers
So
your questions. So
if you pull out, the goal for moderate is 7% a year. And last year it's done 12. You take out inflation, you're still getting a real return of that 7. So but again, hopefully that answers your question, Jesse. Again, it's a bit of a curveball. We need to have a very more specific question to talk about different models, different strategies. They all have the same thesis. All the models have the same vision of what's coming. It's just certain ones will be more aggressive going after it. So in weeks that we're down, it'll be down more. In weeks that we're up, alpha is going to crush, or it's the exact opposite. It just depends on what happens that week or that day.
And what Sean is saying about this, about how you will see an impact. The way that Sean manages our portfolios is very different from the traditional 60-40 model, 30-70 that you see very popular, and honestly, a very archaic and lazy method of managing portfolios. Anybody can can open an account and pick 40% bonds and 60% and leave it there and have it set. But when it comes to all of these changes with inflation, commodity prices, so many moving parts, Sean's able to really look at the data and make adjustments, as opposed to just saying, oh, I'm staying 40-60. I'm saying 60-40 and that's what we agreed on. No, he's always working to hit that target and always always mapping and measuring the data, to get there.
Again, that's another one of those scenarios. I hope the 60-40 people never go away and never change. Just keep doing you. I need somebody on the other side of the trade. So please don't ever change. Don't tell anyone that the 60-40 is just, it's one of those things. If you think objectively about it, it makes no sense. It's just, there was enough studies done on it to where X percentage of the time and every year it does Y. It's like, every year is different. It's just there's things that echo from year to year, and there's things that have trends, but like correlations come and go. Correlations between what the dollar's doing and what the gold is doing break down and firm up, and then coupling, decouple. Like it happens all the time. So like this lazy notion that you can just like do whatever a ratio, lazy, fix it and forget it model is just like, that's fine. I'm not gonna. I don't argue with people like that anymore. If that's your, you're going to see a lot of volatility. My number one job is to take this line and try to make it, smoother. Remove as much volatility from the performance that I can. And that's generally what our models do. They're pretty boring, smooth lines within reason. It's still at the end of the day, still investing.
And I think Sean, you had mentioned before that one thing that you look at is risk. So it's
paramount. Risk adjusted everything. Well, really, it's beta adjusting is the fancy word for it. But you need to be aware of, your sizing is super important when it comes to your exposures to like each model. We're getting into the weeds here. This is normally when Dan would tell me to shut up. But like each model has a max exposure that it can have to either equities or commodities or bonds or equity or currencies. Yeah, that's the only one I was missing there. And that kind of reduces some of your exposure risk. And you need to, the more volatile something is, the higher the beta is for something, you need to decrease that max exposure. And just being risk adjusted is super important. Because I don't have a magic ball. I don't know what's coming. I know what's probable, but that doesn't mean anything. I say this all the time. If anyone tells you they know what's coming, I don't know, a month away, like they're lying to you or trying to sell you something. It's just, we don't know. I laugh at these year-end projections, or in January and February, like, oh, the S&P is going to be at 47.14. We don't know. Nobody knows.
Yeah.
I mean, it's insane.
Mm-hmm.
It's a daily game that you got to wake up every day and try to make the best decisions that you can with the information that's at hand. And anything outside of that, you're just trying to take shortcuts. I mean, I'd love to just stick everybody in a 60-40 model and go play golf every day. That'd be awesome. I think Sam would kill me for that, but I could already hear those emails coming in. But yeah, well, if we don't have any other questions, we finished early today.
Yeah. Yep. It was a pretty good topic. I mean, I feel like you did a great job, Sean, in the Nest Edge and explaining inflation. And so, yes, he will come after you. Yeah. And so yeah, we're gonna wrap up this session. This recording will be sent to you, to your email for those who had registered. Please feel free to share this, with friends, family, anybody who you think will benefit from this investment education. We'll also post this online on our website, where we have a bunch of blogs and resources for clients and newcomers to check out. So thanks everyone for taking the time to join our webinar, and we'll see you next month. Take care. Bye guys.
Adios. See ya.